Hello, everybody, and welcome to my show. I hope you guys are having a fantastic Saturday evening wherever you are. Now, let's get to the news. CNBC reported that the Feds are reluctant to lessen rising inflation by lowering yields. In fact, on Thursday, Federal Chairman Jerome Powell had said the following: some upward pressure on prices could be in the works as soon as the economy reopens. So what do these surge in yields mean for the housing market, the mortgage market, and housing affordability? Now, the government says that incomes have increased to 10%, and by 10%, and that expenses have went down. This is because stimulus checks, and that they're leading prices to go up. Now, George Gammon uses a copper spot chart as an indicator for future inflation. And what he says is the following, quote, copper this year has gone straight up to a point that is almost at an all-time high. This is telling us consumer price inflation in the future. Gammon, he looks at the 10-year Treasury chart from December 20th to March 21st, and he said that it goes from 0.75 basis points to 1.5%. And he also takes a look at the 30-year mortgage chart at the same time period, where it goes from 2.64% to 2.82%. And he said the main point here is that the trend line is going up, increasing for both the 10-year and the 30-year market, which is, quote, he said, indication of inflation expectations. This would put downward pressure on housing prices. And listen to this, people. Purchasing power would go down by, yes, 36%, a whopping 36%, and home prices will go straight down. He said, quote, if this deficit spending continues, these rates will continue to increase, and this will, quote, affect housing affordability enough, bringing down house prices, potentially creating a housing market crash. Now, that's crazy stuff, people, isn't it? Also in the news, Zero Hedge headlined, consumers unexpectedly paid their credit cards for a fourth straight month, have, quote, uncharged a record $127 billion in the past year. Props and kudos for all you guys. Woo! On the downside, though, student loans and car loans have skyrocketed. And Zero Hedge said, quote, it's hit a new all-time high in the fourth quarter of 2020. Student loans have increased from 2.5 billion to 1.7 trillion, while car loans rose from 9 billion to 1.2 trillion. Other interesting stuff. Martin North, he's an Australian digital financial analyst. He did a sit down with George Gammon 2 weeks ago, and he has said the following, that Australian government is now lessening lending standards even with the high debt they have. And the way they justify that is that there's low interest rates. So what the heck? We could do anything, right? That's when they're wrong. This comes as no surprise, as the U.S. lessened lending standards between 2012 and a few months after COVID hit. What do you guys think of that, right? Anyways, I hope you guys liked or learn something there. If you didn't, whatever I said, you put it on that train and you let it go. Okay. Thank you for watching. Thank you for your time and your support. And we'll see you in the next video. Take care and be safe. Bye. And thanks for watching.